Hello, in this video I'm looking at mean reversion using Bollinger Bands. Now mean reversion is the idea that you're going back to the normal. In this case you can see I have Bollinger Bands on a 4-hour pound yen chart. The middle line is a moving average and it is typically 20 periods, but it doesn't have to be, it can be adjusted. And the outer lines are typically 2 standard deviations. In statistics, 95% of a sample set under most conditions should fall within 2 standard deviations one way or the other. So this is the idea that 95% of trading will happen. Same idea really. So when I look at this chart, I can glean the momentum, the trend if you will, and by the 20-day moving average. So in this case the trend is down, and over here it's up. Once you cross the standard deviation, the idea is that you are going to go back to the norm. So in other words, we break down through here, you can see that is more than 2 standard deviations away. We did go back to the norm. Very short-term signal, not a major one. One way you can anticipate whether or not it's going to be fairly large is how wide the bands are, and you can see they really aren't at that point in time, meaning there wasn't much in the way of volatility. They're starting to spread out a little bit more here. You got a little bit more of a move. You can see that we broke down through here and we got even more of a move. Now some people will try to trade back and forth, like they start here and they try to get all the way. But that's a little bit different type of trading, and it also can get you whipsawed quite a bit. But here we are 2 standard deviations above, and you can see we broke down here and then really took off. So Bollinger Bands do kind of make the argument for calm markets. As the trend really picks up, you can see that it doesn't work as well. The more volatility, the less likely it is, at least in the extreme volatility, to reach the mean anytime soon. And in fact, if you bought here, the mean wasn't hit until lower prices. So you do have to be careful in that sense. The best way typically is to buy with the trend. So for example, if I bought here and this is obviously turned into a downtrend, you are going against the overall trend because of the moving average. However, over here the moving average had been kind of climbing for a while, and you can see that all three of these trades worked out. So it's very important to know the trend. It's not that the counter trend trades can't work, it's just that they tend to be a lot more dangerous, like any other type of counter trend trade. But if you're following with the trend, the idea is to take little bits and pieces of the market as we continue to climb.